Hello class, this is Demetrius Wilson. We are now on to Chapter 6. How is cost volume profit analysis used for decision making? And as you notice, and I always speak about, that all of the chapters refer back to the need for information required in decision making. And that's what managerial accounting is all about. All right. So perform a cost volume profit analysis for single product companies. So you have some companies that only produce one product, and you have other companies that produce more than one. Obviously, it'll be a little bit easier to complete this process for companies that only have one product. But we'll start there. That's our basis. That's where we'll learn from, and then we can move on to companies that have more than one product. So what is cost volume profit analysis? Cost volume profit analysis or cost volume profit analysis involves finding the break-even point and target profit in units and sales dollars. So two different ways to find it, one in units, one in sales dollars. But you always have to be cognizant of the fact that we are in business and you need to understand what the break-even point is just so you can create your equation so that you can end up finding how much you need to produce in order to make a certain amount of profit. But just know that you don't want to ever have your company at the break-even point, because if you're at the break-even point, then how are you going to pay staff? You're going to be losing money, and no one's going to be able to get paid, and the business will obviously decline. The profit equation is used extensively in this analysis. Profit equation shows that profit equals total revenues minus total costs, right? So you see as throughout the chapters we split the costs up in form of variable costs and fixed costs, but if you're just saying costs, it's just costs. So revenues minus costs is going to be your profit. The contribution margin income statement is a more refined version of this equation. And remember, the contribution margin is those revenues minus those variable costs. And it's how much money is applied to fixed costs and to profit. We'll talk a lot about that this chapter. What is the key question used to present the contribution margin in a mathematical format? So profit, as we just talked about, equals total sales, right? So your total amount of sales minus total variable costs minus total fixed costs. All right. So obviously, order of operation, you do total sales minus variable costs. You take that total and then you subtract total fixed costs from that. So also stated that it's good to see it in word format and then see it in the actual equation. So then you have profit equals S times Q, and S is what the selling price is per unit, and Q is going to be the quantity sold. And then you have minus V times Q. V is the variable cost per unit times the quantity sold. What's the constant? Q, which is the quantity sold. Because if you sell a certain amount, you get the money or the profit off of those, and you also spend a certain amount, that variable cost, on each one that you produce. And then once you get that number, then you subtract minus fixed costs. And if you see right here in the little legend that helps you out, it says S equals selling price per unit. V is variable cost per unit, and that's why you multiply those by Q. And then F equals total fixed costs, and Q is the quantity of products produced or sold, right? And that's constant in both sides of that equation. So as always, they give you a little diagram with no numbers first, just some X's in place just so you can understand the process and the format. So you see sales is S times Q, right? So that's selling price times quantity, less variable costs. That's the variable cost times quantity. So if I remember correctly, selling price is $250, right? So if we're just taking one, that's $250. So 250 times 1, $250 worth of sales. Less total variable cost, let's say it's $150 if I remember correctly, and take that $150 and you multiply it by 1. So then you have $250 minus $150, which means that your contribution margin, which would be right here, is $100. Less your total fixed cost. Let's say our total fixed cost was $50. So you take your $100 minus your $50, and then you get our operating profit, which would be $50. It's good to look at it that way, kind of imagine the numbers first before we actually put them in there. So what is the break-even point? So the break-even point can be expressed in sales dollars or units. The break-even point in units is the number of units that must be sold in order to achieve zero profit. So we don't want to achieve zero profit, as I mentioned before, but you have to understand and know what that is so that you can then take your equation and say, okay, we want to make $200,000. What do we need to sell? The break-even point in sales dollars is the total sales in dollars required to achieve zero profit. So if you're at a restaurant, you need to know that break-even point in sales. It's not going to work in units. But if you're at a snowboard company, you can understand and you can use the equation to figure it out in units instead. So how do we calculate the break-even point in units? And we'll start with that format. Assume snowboard company sells each snowboard for $250. Unit variable costs are $150. So I guess I did remember correctly. So $250 for each snowboard. It's going to cost us $150 for each snowboard, but that's just our variable cost. Remember, it's not our fixed cost yet. And the total monthly fixed costs are $50,000. So we have $50,000 worth of costs that aren't going anywhere. They are going to stay and remain. So set the profit to zero. So in your equation, when you have profit equals, you're going to set it to zero because you want zero profit because you're looking for the break even. So the profit is equals S times Q minus V times Q minus F. That's our equation that we just went over a couple slides ago. And then you have zero. And then you have 250 because that's our selling price. So you put your 250 right there times Q minus 150. That's our variable cost price or variable cost amount times Q, and then minus 50,000. So we don't know what Q is yet, but we're just solving for the equation. But we do know 250Q minus 150Q is 100Q, so we can do that math, minus 50,000. Well, if you have a negative 50,000 on this side, and you should know this from prior math classes, you want to put it on this side, and then it becomes a positive. So now you have 100Q, and the PowerPoint doesn't show that, but you have 100Q on this side, and you have 50,000, a positive 50,000 on this side. So what's 50,000 divided by 100? It is 500 units. So they need to produce 500 snowboards in order to break even and make no money. So as we go along further in the PowerPoint, you'll see that if I just want to figure out how much I need to sell in order to make $100,000 worth of profit, then I just change that zero to $100,000. So it's not a big shift or change when you want to figure it out for profit. So what is the shortcut formula to calculate for break-even point or target profit in units? So you could do it this way, where it's a little bit longer, or you can use the shortcut. I like to show both. Some people aren't comfortable with the shortcut. So Q equals F, which is the fixed price, plus target profit. So if we're looking for break even, the target profit is going to be zero, divided by S minus V, right? So remember our S minus V in this problem was 250 minus V is 150, so that's going to be 100. So you put your fixed cost, which is 50,000 plus your target profit, which is zero, so that's 50,000 divided by 100. In our equation, the slide before, you got 50,000 divided by 100. So as long as you know what you're doing, you can use the shortcut. It's probably best to learn how to do both. But if you need to take the slow train, then that's perfectly fine, and do it the longer way. I actually usually use the slow train and take it, do the full equation as opposed to using the shortcut method. If you want to find the break-even point in units, set the target profit in the equation to zero, right? So that's going to be zero. If you want to find the target profit in units, set the target profit to the desired profit amount and then solve, meaning that instead of having zero right here, you're going to have 30,000 right there if that's what we're attempting to sell, the amount of money that we're attempting to make. So what information is needed to calculate the break-even point in sales dollars? So some organizations prefer to measure the break-even point in sales dollars rather than units, right? So like the instance I gave was a restaurant. Finding the break-even point in sales dollars requires the introduction of two new terms, right? So it's not as easy when you figure out for sales dollars, but it's not complicated as long as you follow the steps. So one, you have the contribution margin per unit. So how much each unit you sell, how much of that money from the revenue that you get back from that sale is applied to fixed costs and profit, right? And then you have your contribution margin ratio, and we're going to use that more often than the contribution margin per unit because we're actually going to do some math with the contribution margin ratio. So how do we calculate the contribution margin per unit? So contribution margin per unit is the amount each unit sold contributes to covering fixed costs and increasing profit. calculated by subtracting variable cost per unit, which is V, from the selling price per unit, which I already explained in the previous slide. So contribution margin, it's right there, per unit is S minus V. So how much the sales price is minus the variable cost. How do we calculate the contribution margin ratio, which is going to be used more in our equation? The contribution margin ratio is the contribution margin as a percentage of sales, right? So then this, we're going to have to figure out what a percentage is. We want to measure the amount each sales dollar contributes to covering fixed costs and increasing profit. Contribution margin ratio is S minus V divided by S. So your sales price, 250, minus the variable cost, 150, right? We know that that's going to be 100, divided by sales price, which is 250. So 100 divided by 250 is 0.40 or 40% if I'm not incorrect. So how do we calculate the break-even point in sales dollars? So break-even point equals total fixed cost plus target profit, right? So this is our equation, and you'll have it in your book. So you have to put a star there, and remember you have to refer back to this. So total fixed cost, right? I think that's the 50,000 plus our target profit. So let's just say in the instance it's 0 because we're going to look for break-even, and then our contribution margin ratio is going to be 0.40 or 40%. So you go ahead and solve that equation there. So just remember 50,000 divided by 0.40, and that's going to be your break-even point in sales dollars. If you want to find the break-even point in sales dollars, you set the target profit to 0, right? And then if you want to find a target profit in sales dollars, you set the target profit to the desired profit and then solve. So if we want to solve for 30,000, then we would change this from 0, what we do for break even point, and then we want to change it to 30,000, or if maybe we want to put it at 100,000 and we put it right there. So what does a CVP graph represent? So what does a CVP graph represent? And it's always good to see something represented in a graph because maybe it'll click. Some people are visual learners, and they learn a little better if they see something in a visual format. So the CVP graph shows the relationship between cost, volume, and profit. How much it costs, how many are being produced, and how much money we're actually making. The vertical axis represents dollar amount for revenues, costs, and profits, depending on the line, and those are color coded, so you'll be able to see exactly what's what. And the horizontal axis represents the volume of activity for a period measured in units produced and sold. So if you see right here, you see our break-even point, the blue line, you see total revenue. The red line is total cost. So when revenue is the same as cost, that's our break-even point. It's right there. And the quantity at that right there is 500, which we figured out from our equation. Now down here is our profit, right? So we also know at a break-even point, what our profit and everything is right there. So you have those three, and take some time on your own to look at that graph if it doesn't make sense to you. But remember, our break-even point is where those intersect, and remember, our total revenue should continue to go up, and total cost should continue to go up as well, but not exponentially. So that if your total cost is above that total revenue line, then you have a problem with your business model. So what is the margin of safety? And this is a good concept to understand, especially from the sales perspective. The margin of safety represents the amount by which sales can fall before the company incurs a loss. Meaning, if we're at a positive $30,000 in regards to sales, we have a $30,000 margin of safety, because after 30,000 it's break even and we've made 0. Then anything below that, we're going to lose money. The margin of safety can be expressed in units or sales dollars. Tells managers how close expected sales are to the break-even point. Now remember, I did say expected sales, so you have to be careful with that because that's not actual sales as of yet. So here's just a summary of key equations. You can go back to the PowerPoint and pull it up. You need reference before your test or whatever, and check these out. Break-even or target profit point measured in units, total fixed cost plus target profit, selling price per unit minus variable cost per unit. Break even or target profit point measured in sales dollars, total fixed cost minus or plus target profit divided by your contribution margin ratio. Margin of safety in units or sales dollars, projected sales minus break-even sales. So see part 2 and we will continue this lecture.